What I'm going to do is, if you stay till the end, the next 40 minutes or so, I'll just give you one of my courses for free. How's that? And you can just have it. And it's got one of my favorite trading setups in it called the rubber band trade, which I trade most every single day. And it works great, has a high win-loss ratio. And you can trade it with futures, options. You can do it with stocks, commodities, Forex. It's just a real nice, simple technical setup on a chart, and can do it on daily charts, tick charts, minute charts. So yeah, I'll just give you guys that that trade setup for free today. So no obligation whatsoever. Okay, well, let's get this party started. And today I'm talking about Fibonacci trading, how to incorporate Fibonacci into your trading. So what's cool about this is no matter what you're trading, again, whether you're trading stocks, forex, futures, commodities, options, you can incorporate this into whatever you're currently doing. And we're going to start out with some basic stuff for those of you who maybe are brand new to Fibonacci. We'll go over the basics. But then for those of you who are saying, oh yeah, hey, I already know about Fibonacci retracements and that stuff, then we're going to get into some more advanced Fibonacci techniques for our more advanced people. Alrighty, so let's, a couple of house rules here. It says no questions till the end. You can ask a question anytime you want. Hey, it's a free country, or countries, wherever you're from. And, but because we want to stay on time here, and I'm very serious about staying on time, I'm not going to take questions until the end. So you can type if you want to, but I probably won't answer them until I'm done. Please don't trade with money you can't afford to lose. I know you've seen some of these legal statements already, but we get new people coming in and out of the presentation over the course of the whole morning here, so I want to make sure, or the whole day, depending on your time zone. So for those who just came in new, I want to make sure that you see this important legal information as well. So you can read it there. It's for educational purposes only. Most people don't make money. Successful trading is a profession. Here at Top Dog Trading, we do not allow any get-rich-quick mindsets. So if you have one, get rid of it. Don't get rid of yourself, just get rid of the mindset and adopt a professional mindset. This is a real business. This is serious. You know, it takes some time, it takes effort, it takes study, and we really encourage you to, that's really the first step to making money, to being a successful trader, is have that kind of realistic mindset as you come into this business. So here's, we already had a introduction about me, so I won't, I'm just going to go through this slide real quickly, a few of my credits and so forth, but I'm not going to go through all of this. So let's get to the core here. Let's jump right into it. So Fibonacci retracements, this is the thing, this is the technique that most people learn, and it's good. And basically, we'll start with this because this is really Fibonacci 101. What we're doing with Fibonacci retracements is we are looking for what's called an impulse move, from a high to a low, or a low to a high. So in this case, we have from a high to a low. An impulse move is defined as a strong move in the market that is not just a short-term move, but has some energy behind it. So it could have enough energy that the market, even though the market's kind of wiggle, like here it wiggles a little bit, but the overall direction is down in this case. So we'd say there's a strong impulse move to the downside. And therefore, that sets up a dominant energy in the bearish direction. And so we do the retracements to find places where we might want to enter a short position for the continuation of the down move. So after this impulse move from there to there, if it retraces, in other words, moves back toward the origin of the impulse move, if it didn't move at all, it would move 0% back. The next level would be 23.6%. That's our next level. A lot of people don't use this number, by the way, and if you don't, I would encourage you to add it to your Fibonacci retracements. It is significant, and I think you'll find that the market actually holds at this level in very, very strong bearish moves, and conversely for bullish moves, obviously. But in a very dominant energy market, if it's really moving down dramatically, then you will quite often get very little retrace, and it'll just come back to the 23.6 and then resume its downward move. Then the next level is 38.2. A very famous level is 50. and that's the halfway move from 0 to 100, obviously. That's not actually a Fibonacci number, but there's a case, some people make a case for it. I think it's a little using a lot of imagination, but it's just, you know, the halfway point. Gann used this a lot, and it is a significant level at which markets do retrace to. 61.8, that is actually the golden ratio. That is your primary Fibonacci number. And then I use 76 as the final before it gets back to 0. So again, what we're looking for with Fibonacci retracements is if you have a dominant move to the downside, we're looking for a price level at which to go short if we believe that the downward movement is going to continue, the downtrend will continue. We're looking for an entry point to get in on that downward move. In this case, it comes back to the 50%. All right, oops, I deactivated my slide here. So, Fibonacci numbers were discovered in the West by Leonardo of Pisa, who is known as Fibonacci. That simply means the son of Pinocchio. And he introduced the sequence to the West in 1202, but actually, like a lot of things in the West, they'd already been discovered in the East long before that. They've been used in India for many, many, many years before he so-called discovered them. Now, why are they significant? They're found significant because they weren't originated with trading. They actually were discovered in being part of the structure of nature and an organizing principle of nature, actually. And so as scientists and mathematicians studied the structure of nature and how things are patterned in nature, looking at all these kind of things like this and more, they started seeing ratios in the way that things grew. And this is how they came up with Fibonacci numbers. So there's various other kinds of mathematical numbers, geometrical patterns that are talked about in trading, Gartley patterns, astrology, squares, etc. But in this webinar, we're going to just use these ratios here and their extensions. Okay, so therefore, when I talk about an extension, I would mean, okay, from 0 to 100, but then also you could go 123.6, 138.2, 150, and so forth, and even 223, 338, 350. So that's what I mean by extensions, and we'll show you how we apply that. So if you want to write those down real quick, if you don't already have them, these are the numbers that I use. I would say that 23.6, a lot of people don't use, and 76.4, again, some people use 78. I like 76.4. I don't think it makes a whole heck of a lot of difference, frankly, but your real staunch Fibonacci people, they would go with 78. Just through my own experience and for money management purposes, just being a realistic street trader, I find 76.4 is a better level. It's a more conservative level. The market doesn't always get back to 78, so if it goes to 76, then I'm golden. Okay, so Fibonacci retracements, again, just to review real quickly. So there's our impulse move from a high to a low. That's what sets up our primary structure, and then we have our retracements. So as you see, it goes to 50%, then it comes back down to where? 23.6. Then this time it goes all the way up to 61.8, and then it comes down to 23.6, back up to 61.8, this time back to 38, and etc. So my point here is it doesn't even have to continue the trend, but it does continue to provide support resistance levels. And so they're basic ratios at which swings in the market tend to occur. Now let's go beyond Fibonacci retracements, that's basic 101, and let's go to Fibonacci 102. And that is Fibonacci extensions. So here would be our equivalent of an impulse move from a high to a low. Now, what we want to do is instead of looking for a place to enter, such as here, that would be your retracement, now we're looking for profit targets. In other words, we're saying, okay, here's our impulse move, and we're going to go short when it retraces, but where are we going to get out? How far do we expect this to go? We expect it to break this low, but what are going to be our profit targets? maybe there's no, special significant support resistance levels down here, and we've got to create some. This especially works well to the upside, where you're above, you're in new highs. Maybe stocks are achieving brand new highs where the market's never been before, and people say, gosh, there's no resistance levels up there because we've never been that high before. Well, this is one way to create resistance levels by using Fibonacci extensions. So these are all drawing tools. So you'll find them in the drawing tool section of your charting platform, whatever your platform is. So again, this is a 3-point drawing tool, by the way. So Fibonacci Retracements was a 2-point drawing tool. You just draw from there to there. Now, with the 3-point drawing tool, you'll hit this, drag it down here, click here, and drag it up here, and the drawing tool will still be active. And then it will plot these levels below. So now, as you can see, we've got our 23, 38, 61, 76, 100. But see how it plots some of these levels below this one? And so it plots target levels. So where do we want to get out? What's our target here? Well, so we've got the same ratios. Notice the ratios don't change. It's just a different way of drawing them. Looking for, instead of entries, now we're looking for exits. So retracements are for entries, extensions are for exits. And as it comes down, sure enough, it goes to 76.4. Then where's it go? It goes to 38. Then it comes down to 100. Comes back up, goes to 23, comes down to 76. And so you see, yeah, this is way of where swings normally go. Now, the 100% level here is very significant. That is called a measured move. It's so significant it has its own term called a measured move. And so what that means essentially is if we were to, well, let's just do it instead of saying if we were to. So if you take this level, and my drawing is horrible, by the way, especially trying to do this with a mouse. So that range is the equal of that range. And that's what a measured move is, and that's why that's 100%. And so that's a target level that a lot of traders will use. And so, yeah, Brian says the 50% level is psychological. It is, absolutely. Actually, all these are. But the 100%, a lot of times people say, well, this or that is just a self-fulfilling prophecy in the market. Yeah, well, heck, that's why it works. So don't diminish the fact that it's a self-fulfilling prophecy. That's how markets work. They're based on mass psychology. Masses of people are looking at the same thing. If they'll see the same thing, they're going to respond to it. So absolutely, great comment. I love that, Brian. Brian's on the ball. He's 100% correct. So yeah, okay, so let's take this off here and let's get to, oops, I gotta get my laser beam back here. There we go. Doo-doo. All right. So now let's take it to the next level. We're getting deeper and deeper and deeper. We're going to deep dive into Fibonacci here. So now we're going to combine the first two techniques we just learned. So again, we've got our impulse move, this time from a low to a high, and we have our retracements. So those numbers are going to be seen right here in this column, if you will. So 0% retrace, 23.6, 38, 50, etc. And so we've got our lines that go across there, horizontal lines. Then I also, if you notice here, there was a big spike up here, big swing high, big swing low, and then we went up to that big swing high. So we can use that to draw Fibonacci extensions. So from there, so now we use our Fibonacci extension tool, 3-point tool, 1, 2, 3. And now in this little column, if you call it that, this is where our Fibonacci extension ratios are. And so you can see them there, 61, 76, and 100. Now, what happens is we look for places where these levels come close together, where they cluster. And that provides a little stronger support resistance than just a single level. Now, back to Brian's comment. Why? Well, it has to do with the mass psychology of the market again. So the reason that clusters work, and by the way, you can use clusters not just with these two tools. You could use clusters looking for where floor trader pivots. cluster with major previous swing highs and lows, or with other Fibonacci levels, or with 52-week highs and lows, or with major waves in the market, cycles, whatever. So any support resistance levels you can use. In fact, I would even make an argument that when there are different types of support resistance and they cluster together, it's an even stronger signal. And here's why. Here's the logic behind that. It's because you'll have one group of market participants who maybe are, if it's intraday trading, maybe they're watching floor trader pivots, okay? And a lot of people watch those. And those are set numbers. Those are set numbers. So they're just, it's a mathematical formula. The numbers are what they are. Everybody will see the same number, which is different than Fibonacci. So one of the weaknesses of Fibonacci, let's just talk about the pluses and minuses here. One of the weaknesses of Fibonacci is it's relative. So one of the questions I get a lot is, well, how do you know which low and which high to use for drawing these levels? That's a great question. It's a very insightful question, because embedded in that question is the acknowledgement that that is somewhat subjective. So my basic answer to that question is you look for major swing highs and lows that would stand out to anybody looking at the chart. And the reason for that is because that's where most people will draw them, and therefore those levels will be, the people will react to them because that's where most people are going to draw them. But still, it is subjective. And it also depends on the scale of the chart. So for example, this is a 5-minute chart. Well, somebody who's using a 60-minute chart, they're going to use different highs and lows, and so their Fibonacci levels will be somewhere else. And someone using daily charts somewhere else. Someone else using a 144 tick chart, those levels would be somewhere else. So that's one of the weaknesses of Fibonacci, is that they are not just set numbers that every single trader on the planet will see. Floor trader pivots, yes, as long as they're using the traditional floor trader formula, and granted, there are some other formulas, but if they use the traditional floor trader pivot formula, then everybody sees the exact same levels regardless of scale, regardless of time frame, whatever. So I would say that floor trader pivots are locked in numbers and therefore even better than Fibonacci when using them with clusters. Okay, and the same with major highs and lows. At least people looking at the same scale chart will all see those and respond to those. So I would say also this, on long-term charts like daily, weekly, and monthly, Fibonacci numbers tend to be more congruent among all traders than on intraday charts, where you'll have people trading all different time frames. But daily, weekly, and monthly, you got so many people looking at those charts that they're more reliable as well. So bottom line is, you'll have some people looking at one. In this case, you'll have some people looking at extensions. You'll have other people looking at another, in this case, retracements. And so when two levels come together, you've got more market participants who are seeing those levels and therefore responding to them. And again, that's true whether it's floor trader pivots or anything else, okay? So that's the psychology of why clusters provide more solid and reliable support resistance. Now, let's get into the advanced stuff. This is the stuff most people don't do. So now, you'll notice that what we've been looking at so far are Fibonacci price levels being horizontal lines. Now, what the heck? I got vertical lines on here. That's because lots of people use Fibonacci for time, but there's two axes on the chart, right? You've got your time, and then you've got this other axis down here, or this is price, I'm sorry. You got price, and then you got your other axis here, I'm thinking ahead. This one is time, the x-axis and the y-axis. Chart's a two-dimensional object. And you know, it's interesting, but lots of people talk about price, but very few people talk about how to trade time. And that's really, really important to measure time in your trades. It's half the chart. It's half the chart. So with time extensions, what we do is kind of the same thing. We start out with an impulse move, in other words, so the principle is really the same. And so here you see I started out at this low, and I went to this high. That's the impulse move. So from that low to that high. And then they're extensions, so they're going to measure levels beyond where I drew the line. You can see the little line down here, but it's really measuring this high. So then our next level comes in here at 123, same ratios, 123. And sure enough, the market puts in a low. Here it just kind of goes sideways, right? So we go into a low volatility, back to our previous speaker, low volatility situation, and then boom, we get a kick out of that. Then what happens? Well, if you were to draw these levels ahead, this little channel ahead, it breaks out, comes back, retraces right to the high of that channel, and then at 138, that's the time it decides to create another impulse move. And then when it does that, what time does it shift? 150. That's when we get the next time for the market to put in a swing high. And here's another one. Now, one thing I need to point out here, because I always like to point out the weaknesses of things, or I'm not an evangelist for any one technique or any one style of trading. I think they all have their advantages and disadvantages. So I've already shown you that a little bit, but let me show you again with Fibonacci time extensions. They do not identify every single major swing high and every major swing low. So don't count on it. Doesn't catch that high, doesn't catch that low. So is that a problem? No. I mean, nothing's perfect. So the point in trading is you're never going to catch every major move in the market or even every minor move. Just not going to happen. So markets are not that neat and tidy. Markets are not, your tame little purse puppy. They're more like the wild tiger that can be tamed for a little while and you think you got it tamed and then just lurch out and just destroy you at any moment. So what we do is we don't worry about, and we don't try to reverse engineer every move in the market because that'll just drive you crazy. The reason it'll drive you crazy is not every move has a high probability setup before it starts. So we as traders are just looking for that. We are looking for the moves that have a high probability setup before they happen. And those are the only ones we take, and the rest, bygones, just let it go, whatever. Market moved, oh well, markets move all the time, big deal. There was no high probability setup, so I was right not to take the trade. And amateur traders will just pull their hair out trying to reverse engineer, how could I have gotten into that? And they'll eventually convince themselves of some, combination of things that could have gotten them in. The problem is that won't necessarily work over a large sample of data. And what we need is things that work over a large sample of data to have a high probability scenario. So flukes happen here and there. Don't worry about it. Forget about it. Forget about it. Okay, so that's good. Let's move on to the next one. Now here's one of my favorites. This one's cool, but I'm going to give you a warning about this one too, that a lot of people don't tell you about. Now here we're talking about Fibonacci circles or arcs. Could be called either one on your charting platform depending on the software you use. So both are correct. I guess technically circles is the more correct number. Or correct number, I'm sorry, I got a cold here, and also I think fast and I talk fast, but I think faster. So I'm always thinking ahead of what is coming out of my mouth. So circles is the, I would say, more correct term, because like here they look like arcs, right? This blue arc, this black arc. Okay, it looks like an arc, but if you were to scale out, pull out of this so you could see it from like a bird's eye view, it would be a 360-degree circle. So it depends on the scale as to what it looks like, but it is a circle. Okay, that doesn't really matter. The point is that I just wanted to point that out because on your software, it may be one term or the other, and they're the same thing. Now, what's cool about this tool is it measures both time and price in one drawing tool. Okay, so that's awesome. We've got a high here. Again, we started with the same principle. We go from a major high to a major low. We look for an impulse move. And then when you click off of that, boom, these arcs will come up. And so now what's happening is because it's an arc, because it's curved, it is moving over time. The same line is moving. So at this point, it's measuring that time. At this point, it's measuring this time. Now at this point, it's at that time. At this point, it's at that time. And then at different prices too. So here, where we get this time and price confluence, and that's what's really great about this tool is that, well, W.D. Gann used to say trading was all about the confluence of time and price. And this is one of the tools that helps you find that. So with one tool, you see it climbing up. In fact, let me get my, I tend to get a little messy with my drawing tools here. So let me clean that up for you, and let me just use this. So notice here, it climbs up the arc. See price climbing up the arc and then falling. So therefore, that's the price and time that the market puts in a high. Notice it does not catch this one. It does not catch that one. And that's okay. So we just wait for one where it does. It goes to this next one. Again, time and price. Goes here, boom, 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 and then bam, comes down. Now, this is the warning. I said that I had a warning to you about this tool, and a lot of people don't know this, and it really messes them up. And then they say, oh, it doesn't work. So because it measures time and price at the same time, and it's an arc, you have to lock the scale of your charts to use this tool appropriately. Not even appropriately, correctly, to make it work right. Because if you don't, if you have, for example, your scale set to adjust for showing all the price bars from high to low, then the scale will automatically change on your chart as price continues to move to the right side. And these arcs, they'll actually move. Instead of touching that bar, later on you'll find, oh, that arc went over here. How did that happen? So what you have to do is you got to lock in the scaling so it doesn't change. And then they'll stay where they originally were put, which is obviously what you want. Okay, now here's the deal. As we saw with some of those levels, when the price, for example, with Fibonacci retracement and even extension, we saw that it would go slicing through the 23.6 resistance, and it would go slicing through 38, and then it would eventually go up to the 50%. So now there's another question here. Wait a minute, Barry, how do you know which level is going to hold this time? How would we know that it wasn't going to hold off 23 and then continue a downtrend? Or how did we know it wasn't going to hold 38 and continue a downtrend? How did we know 50% was the level that was going to hold? And that's a great question. That's a critical question. And the answer is, again, these geometry tools cannot be used in isolation. They must be used with other things. So therefore, what you have to do is add what I call more energies. And my whole method is about measuring the energies in the market. When I talk about energy, I just talked about the energy of money. The energy of money. Money flowing in, money flowing out. So the actual buying, the actual selling, how strong it is. Well, here I break the energy down into 5 ways. So here's my little list of 5 things I look for. When I'm trading, I just look at these 5 things. Number 1, trend. And I just use a moving average for that. And by the way, the reason I use indicators don't make me any money. Okay, if they did, we wouldn't call them indicators, we'd call them what? Money makers. But they're not money makers because they make you 0 money. But what they do is, well, let's call them what they are. Let's just get to brass tacks. An indicator is just a mathematical equation. That's what it is. So there's nothing magical about an indicator. There's just something mathematical about them. Now, math isn't wrong. Math is just what it is. So the reason I use indicators is to give me a value, an actual objective value or number for each one of these energies. It's because my trading method is very, well, it's objective. It's not subjective, it's objective. And for it to be objective, it has to be rule-based. To create rules, you've got to have solid numbers. So I have, indicator that measures trend. It gives me a number. Here's the trend. Momentum, use a momentum indicator. That's the number of momentum. It is got a value to it. So there's no guesswork involved. For cycles, use an oscillator. It tells me the time to get in, the time to get out. support resistance. Now, this is where Fibonacci kicks in. So Fibonacci is a support resistance tool, and it's energy number 4. So you see it's it's actually 1/5 because we have a 5th energy. So it's 20% of my methodology. Can't be traded alone. It's one piece of evidence, if you will. And what we're doing is we're using a preponderance of the evidence to put together a probability scenario to trade the markets. And so this is one. Other ones, other support resistance levels, previous highs and lows. Again, floor trader, Fibonacci fits into this. And then the fractal energy is the 5th, and that's just using multiple time frames. So if I'm trading a setup on a daily chart, I would look at a weekly chart, and I would call that my fractal energy. So we use these things to determine probability scenarios, as I mentioned. So I've got these 5 energies, and I'm asking myself how many of them align at the same time, and I give the trade a score of 1 to 5. Obviously, the higher the score, the higher the probability of the trade. So the 5 independent witnesses, that's the key. These 5 energies are each one non-correlated to the other 4. That's the key. So again, it's not the indicators. I mean, you could put 5 trend indicators on a chart, but they would all measure trend, and you'd have a score of 1. So it's the indicators measure the energy underlying it. It's kind of like having a speedometer. A speedometer is, I actually like to call them instruments more. I could look out the car and say, oh, it looks like I'm going 20, and then I look at the speedometer and, oh, I'm actually going 35. I think we've all had that experience where we're going faster than we think we are. So same thing here with the charts. These indicators are just like instruments on the dashboard of the car or in the cockpit of a plane. And each one measures one aspect of how that is moving. And we put all that information together to then drive the car or fly the plane. So for trend, I use the 50-period simple moving average, and that's it. Now, some people say higher highs and higher lows. I mean, we could go with lower lows, lower highs. That's not a trend. The trend is the extended general direction of the market. So trend is always a long-term move. I use the 50-period simple moving average. Very simple. I don't use any proprietary indicators. Momentum, here's what I use for momentum, higher highs, higher highs. Look how momentum makes a lower high while price still makes a higher high, because this measures the strength of the trend. See, the trend is up, but it's getting weak. So now I don't want to go long anymore, even though trend is up, because trend is lagging, momentum is leading. This says, no, we're getting weak. So remember that. Only trade strong trends, not weak trends. And then energy number 3, cycles. In fact, I'll give you guys my cycle indicator if you like it. And this measures those oscillations I was talking about, the wiggles, the down, the up, the down, the up, the respiration of the market, I like to call it, the inhaling, the exhaling. And support resistance, we talked about this already. So there's your Fibonacci levels, see? So here's a good example. It retraces and it slices right through the 23.6. Why? Because there's my cycle indicator, and the cycle indicator is still screaming up, and therefore we don't have the confluence of time and price. We've got a price level, but it's not time to put in a high. See, that's the time. That's the time. Here we get confluence of time and price. By the way, that's a cluster of that high and the 50% retrace. Momentum, very weak to the upside. See, if the market's going to slice through resistance, momentum's going to be strong, but no, it's weak. And so we've got a weak trend, or a weak move up, cluster of resistance. Trend, by the way, is down. This is my rubber band trade I'm going to give you guys here in like 1 minute. So this is the rubber band trade structure. It's price above a downward angling 50 MA. It looks like we're going up. No, we're not. The long-term trend is still down. We want to trade down. Momentum, very weak to the upside, and it's time to go down. All right, and then the 5th energy is just the fractal energy. So if I'm trading, what do we got here? 2-minute chart. I like to do a 3-to-1 ratio or 1-to-3 ratio. And so I use a 6-minute chart over here and only take a trade. Even if everything sets up beautifully over here, I'm only going to take the trade if the dominant energy in that longer time frame is in the direction of my trade. If it's not, that is a filter, and I will not take the trade. It is do or die. the 5 energies, that's the most important one for me. So my 5 energy method works for all markets and all time frames. I trade stocks, commodities, options, currencies, and futures. I do investing, swing trading, and day trading. It's very simple. It's very objective. Counting to 5. I think we can all count to 5. So here's my freebies for you today. I promised you one of my free courses, so here it is. It is a 5-day video correspondence course. I'm going to give you 5 videos, and we'll give you one a day. I want to keep it very easy to consume. Each video is about 15 minutes long, and the topic of this course, by the way, is how professionals trade different than amateurs. So we go into all kinds of stuff on what distinguishes, even in, like, for example, we show head and shoulders, double tops. A lot of people think they know what a head and shoulders is, but they miss the details. The devil's in the details. It's not just a higher high and a lower high. That alone is not a head and shoulders at all. So there's other things that have to be there for it to be a valid head and shoulders. And then there's some that are highly profitable and others that are low probability. So I go through all that in this course, which you get for free. And we do double tops, we do other things in there, and kind of go through the devils and the details, the common mistakes amateurs make that they don't even know they're making. You know, it's the old thing of you don't know what you don't know. Well, after this course, you're going to know. And the way I teach is we have feedback loops. So at the end of each video, there's an interactive quiz. So you can make sure you get the points. You get my rubber band trade. That's going to be in video number 4, by the way. So you get an actual trade setup you can start taking and hopefully start making some money with. Obviously, you should trade it on a simulator or demo account till you get the hang of it. And then, yes, you can get my cycle indicator for free. That's going to be given out on a webinar. So that's another free webinar. No charge for that, no charge for the indicator, no charge for the tutorial. So, and just by signing up, you get all of it. Just to go to this link right here, got a little bit.ly link for you. I stand, obviously. But yeah, go there, sign up, and everything for free. So if you have any questions too, you can email me at barry@topdogtrading.com. Oh, I should put my email address up there. But again, it's Barry, B-A-R-R-Y, at topdogtrading.com. And let me see if I can answer 1 or 2 questions here real quick. And we got Chris. I already own your course, Barry. I love it. Oh, okay. Well, that worked out well. Thanks, Chris. I'll send you a check. Niraj asked which technique has a better success rate. I wouldn't say any have a better success rate. They're just used for different purposes. So as I said, retracements used for entries, extensions used for exits, arcs are used for a combination of things, and you can put them all on the chart as you saw there. Brian, tools in the toolbox. That's right. Does it work only in an uptrend? No, it works in an uptrend or a downtrend, either way. Let's see, this question. Do you not think the 50 days moving average is slow as the trend is going down? Yes, the trend is always a lagging indicator. That is correct. Trend is always, by definition, a lagging indicator. Whether you use 50-period moving average or anything else, by definition, and if you want, you can email me about details of that, but it just is. And so in my method, what I do is I combine lagging indicators with leading indicators. And I remember one time when I first started studying with a high-level instructor, and he started talking about lagging indicators. And I thought, this guy's nuts. Why would I want a lagging indicator on my chart? I thought he was completely insane. And, you know, and I took like 5 courses from the guy, and I never got it until like a year later, all of a sudden, somewhere out of the blue, it occurred to me what he meant, why you need a lagging indicator. And the bottom line is, lagging indicators are more accurate, but leading indicators, so-called leading indicators, they're less accurate, but they're more timely. And so you can put together a strategy of using both together and have the best of both worlds. And that's what I do. Great question. Where do you get the course? The link? Yes, Alex, right. To get the course, just go to this link right here, bit.ly/ii-webinar. That's where you'll get the course. Absolutely. Let's see here. I don't have a lot of time, so I can't answer long questions here. Oh, here's one. You can connect with shadow also or from the body. I recommend, yeah, it's a good question. Some people use the real bodies, some use the shadows for drawing their Fibonacci levels. I tend to use the shadows or the wicks. Yeah, that's what I personally do. And there's a reason for that. Again, it has more to do with money management and so forth. But both approaches are valid. Both have good reasons for doing them. But that's what I do. I like to capture the entire range of the market, right? And Joseph asks if I have a good book to recommend. There's a lot of books on Fibonacci. I don't really have one particular book I would recommend. And what do I use for oscillation? Okay, so for oscillation, I use my cycle indicator. And if you guys sign up here at this bit.ly link, then you will get access to my cycle indicator via the next free webinar that I do.